Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Paul Winkler here, talking the world of money and investing. You know, whatever happens to be in the news, there'll be something I might be talking about. What I think might be on your minds will be things that I'll be talking about, typically driven by, because a lot of times we think about things based on what we're seeing in the news, and it brings up questions. And one of the things I saw this week, let me preface this with my view on where we get information about investing. Most of us think about it, we get information about investing, we turn to the financial channels maybe, some of us. And of course, you'll have the talking heads on there and you go, okay, what's their bias? Well, who do they want to interview? They're going to want to interview CEOs of companies. And you had a lot of that with Davos. And, there's a lot of people talking about Davos, conspiracies about it and so on and so forth. I'm not going to necessarily get into that. But the thing that you're doing is you're talking or hearing from somebody that would love for you to buy their stock or to create demand for their stock, because if they can create demand for their stock, they can drive the company price up, or they can keep people off of their back. If they're talking about their company and they're the leader of the company and they would like to keep their job, maybe if they are able to talk about what their strategy is for running the company, then they can get people to not necessarily get on their back about how they're running the company. There's a lot of talk about Disney, as a matter of fact, this week in that particular vein. But one of the things that are another place you might get information from maybe a mutual fund manager that's being interviewed, or maybe an investment person. It was back in the day that you would have these companies that do a lot of these organizations that put out magazines would call me and they would say, hey, what do you think? We want you to come on our show. And I go, oh, great. Yeah, really. Wow. And you find out that you have to pay to be on their show. And you go, oh, wait a minute. This is so basically your article in your tabloid or in your magazine or whatever is just paid advertising for the investing industry. Oh, okay. I kind of see how this stuff works. And there's some things that I had done where I had a PR person who would just put me on the TV program. But a lot of times you'd have these TV programs you have to pay to get on there. So it's credibility for the investment advisor to get on TV and not necessarily what it appears to be. But it can be worth it if you have a message that's out there and you want to get out there. Hey, there are radio. The way radio works a lot of times is that you have paid advertisements, and you hear that the show's brought to you by. And then you have the ability to sell advertising inside of the slot. That's how I started. Actually, I actually had people that would sponsor the show, and I had dentist, I had a CPA. I had a home decorator, an interior designer, a restaurant. I had a lot of people that actually sponsored this show. It's how it got started. I was very, very thankful to these people. But that's how that works. But what happens, we're getting information from people selling us something quite often. And that is why I got away from the sales side of things. So here, what we do is, as a registered investment advisor that takes absolutely no commissions whatsoever, is we don't have any investment providers in between. So when I'm giving information, it is based on my research and based on my beliefs and what I believe is to be true. But I always got my information, but I would second guess it and go, well, is this really accurate? Is it, where's the information coming from? Does it make logical sense to me? And that was a big thing, is it make logical sense? Because if there's a logic to it, like, for example, when Gene Fama, University of Chicago professor, was talking about and teaching on the Gordon growth formula and cost of capital and looking at PE ratios and where returns came from, I was able to go, okay, I can put one and one together and it does equal to, it makes sense what this guy is saying. So the information that we're getting from the industry, being a sales side of things, can be a little bit hard to wade through. Well, Fisher is one of these guys that is an RIA. Full disclosure, we don't use any of his services whatsoever because I just don't believe in what he does or how he operates. So I've never chosen to, sign up and work with them at all. But he has this thing about annuities that he puts out there. And he has actually coined this term, I hate annuities, and he's actually registered the trademark. I hate annuities. So you may see, if you're going out there and doing a search for something, you may see one of the ads pop up. And especially if you're searching for annuities, you'll see, bam, I hate annuities. Well, I like academics when it comes to getting information because typically they don't have a dog in the fight. But here is an exception. And I'm not going to talk about who this is or anything that is pitching a fit about Ken Fisher's stance on annuities. But I just want to point out that sometimes you'll have colleges actually run by insurance people. and you go, okay, what are they going to recommend? What do they think is a good idea? Well, typically they're going to think insurance is a good idea, and annuities, being an insurance product, are a good idea. And it's not that they're always a bad idea, but get the idea that sometimes what'll happen is insurance people will go, hey, look at this academic. This professor thinks that insurance is good or that annuities are good. You ought to think that annuities are good. Now, I am in the middle. There are times when annuities do make sense. Some people will say, well, Winkler always hates them. He never has anything good to say about them. No, I think that they're a product that is overused and oversold out there because of the level of commissions that are typically paid on these products. That is the problem that I have with it. I don't have a problem with the concept of an annuity. The concept of an annuity is you put money in and you have a certain life expectancy. They're going to spread the money out over your life expectancy. A pure annuity would be that if you get paid for 1 year, but you have a 20-year life expectancy and you die after 1 year, the money's gone. Because they're taking the risk that you might be living for 30 years past your life expectancy. So that's the idea behind it. Well, this article basically says the RIA famously argues that anything can be done with annuities can be done better with other investment products. And then it says, from an academic perspective, total refusal to recommend an annuity is not the best interest of retirees is the stance of this person, this academic, who works for the company that actually is owned or run by, an insurance company. The guy used to be a CEO of one of the big insurance companies. Now it says, Ken Fisher has mounted one of the most successful attacks on single financial product in history. Consumers searching for annuities have seen ads explaining earnestly why retirees shouldn't buy them. He's even registered the trademark. I hate annuities. No secret, he doesn't like them. And he says, they're a source of many consumer complaints. And the insurance industry has generally done a remarkable job of creating an opening for someone like Fisher to capitalize on negative product perceptions as an honest alternative for retirees or investors seeking retirement advice. He says, on his site, he notes that he doesn't sell annuities. Never have, never will. Why? And he says he's fond of saying that he hates them. He says because he believes anything you can do with an annuity can be better done with other investment vehicles. Now, I would generally disagree with that you can't do what an annuity does because an annuity is an insurance contract. So I've had situations, and one I like to give as an example was a guy that came to me one day, and he says, I've got Mom. She has limited amount of money left. She has very, very little left, only like 100,000, as I recall, something like that. And she's like 86 years old. And what do you think you ought to do? And it would have been incredibly negligent on my part to say, hey, let's go and invest it. Because the reality is I don't know how much longer she's going to live. She didn't know how much longer she's going to live. Nobody knows how much longer she's going to live. And what happens, let's say if you're that age and you have a 5-year life expectancy, then the insurance company is only needing to spread payments out over a 5-year period. Likely. Now, there's a possibility they might have to go 10, 15. She might live to 96. She might live to 101. We don't know. But let's say that her life expectancy is 5 years. There are some people her age that are going to be gone a year from then. Now, in her case, if she lives longer, the people that did the same thing that she did, buying an annuity and spreading it out over the rest of her life, the people that died early would be subsidizing her, because maybe they only got a payment for 1 year and they had a 5-year life expectancy. That leaves 4 more years of payments to go to her if she lives 4 years past life expectancy. Very, very much simplifying, but I hope you get the idea here. So what happened in that particular case is that when I explained to her the money's gone when you're gone, she was like, I don't like that. And she said, and I says, well, you can do a certain period, 5-year certain, which is literally they're going to pay you for life if you're around for 20 years. But if you're only around for 2 years, they're going to pay you your family an additional 3 years. So they're going to make sure that certain that there are going to be 5 years of payments that come out. Now, how do they do that? Well, they reduce the payment. I mean, there's 100 pennies in the dollar. They're going to have to reduce the payment. And that's exactly what they do. So what happens with the contract here is that in this particular case, it just goes for however long she goes. And then if she's gone, it's gone. Now, in this particular case, this academic is writing about what the benefits are of this. And the benefits, he's right. You have something that goes retirement income for life as long as you're around. Now, one of the things that he makes a point about in this article is how profoundly confused they are that people don't actually annuitize. They don't actually like to take this income for life. They don't like to take the risk that they could be disinheriting their children and their grandchildren. They don't like losing control. And they're like, well, why? I can't believe this makes no sense. Now, the point that I want to take issue with in this particular article, I want to take issue with the number that he uses at the end of the article, because this is what his whole premise is based on. And you may have an investment person, an annuity salesperson out there using an article such as this to say, hey, look, even academics believe that this product is always great. It could be really great for you. Not always great, but could be great for you. He says, he says, can a fiduciary, that somebody has to keep your best interest first, can they with good conscience, he is saying here, can they with good conscience, I'm paraphrasing, tell a 65-year-old to liquidate a product, get rid of it, let's say with a $50,000 contract value. So, you stuck $50,000 in the contract, in the annuity, that would have paid a $5,000 lifetime income benefit. So, $5,000, 10% of the account value. Which you look at that and go, wow, that's 10%. You can get that every year. And if you're around for 50 years, that's wow. It's huge. I mean, think about it. You get all your money back in 10 years. And this is a 65-year-old, which will quite likely be around for more than to age 75. So you think about it. He's making this point and you go, wow, that really does seem pretty compelling, doesn't it? It says a healthy 65-year-old woman who has enough wealth to meet the Fisher minimum can expect, on average, to live to age 89. So you look at it, they're probably going to live past the age 75 that he's talking about here. The internal rate of return on a policy liquidated for $50,000 at 65 would be 8.8%. So I checked the math. I went to my little calculator and I checked the math, and indeed he was correct that was the internal rate of return. But like I said, I don't just stop there. I like to go a little bit beyond and check the math on things, because I don't necessarily trust anybody, whether they say that they're a professor or not, or, whatever. I just don't trust. So I actually went and got a quote on a 65-year-old woman. What I found is that the top payment, if you did it for life, even if you said, no, I am going to go for broke, I'm going to do it for life, and, if I die in 1 year, the money's gone. I don't care. I didn't do the 5-year certain that I talked about a little bit earlier. The payment was $307 per month. Well, you do the math on that. That's quite a bit less than the $5,000 per year, right? It's a little bit over $3,600 per year. That's a pretty big cry from the amount that he was saying that you would get. The internal rate of return drops down to 5.3%. Now, not bad, right? Not bad. But think about this. When you are in a period of very high inflation or higher than usual inflation, interest rates are higher because that's how interest rates work. There's a very high correlation between the two. Number one. Number two, even with interest rates being high, are they that high? Because you look at 10-year treasuries and you're looking at about 4%. So this is actually higher than the 4%. And we're not even assuming that the insurance company has to make a profit. So where are they getting the return to be able to give you a 5% return is the question you should be asking yourself. And when you get down to it and say, well, where are they getting it? Well, there was an article written, as a matter of fact, a little bit back, in an annuity website. If you look, well, where would you not expect an article like this? An annuity website. But this was actually on an annuity website, annuity.org. Is there hidden risk in your annuity company's balance sheet? And they talk about the level of bonds, that about 62% of investments sold or held by U.S. insurers are bonds. What risks do the bonds hold, or what can they hold? Well, reinvestment risk. What if when those bonds mature, they go and invest that money at lower interest rates, but they basically promised you a high interest rate like that? Let's say if interest rates come down, then what happens to the insurance company? Now they've got a problem. If interest rates come down like that and they reinvest the money at lower interest rates, they've got an issue on their hands. What are some of the other things? We look at that and we go, well, they're investing in something else. What else could they be investing in? Well, corporates. Well, what are the problem with corporates? Well, what if corporations go bankrupt and they can't repay their debt? That's a default risk that you're dealing with bonds. So you got reinvestment. And what if interest rates go up? Then you got another problem on your hands. Can you say Silicon Valley Bank, where all of a sudden interest rates went up and all of a sudden bond prices went down, putting the bank at risk? So anytime you see somebody paying a little bit higher than market interest rate or assuming a higher than market interest rate, and you got to be thinking that they've got to get a profit in there. They somehow have to be earning higher interest rates on the money in order to pay the person that end interest rate that I said is in that product, that's built into that product. Because I used the life expectancy that this professor used in the article, age 89. And that's what the internal rate of return came out at for a 65-year-old female using Tennessee Insurance Company. I use Tennessee as the state of issue. So you look at that and go, well, wait a minute, this could be an issue, right? So, recognize that there are times when insurance company products like annuities do something that nothing else will do. But recognize that quite often they are being used as accumulation vehicles, not as distribution vehicles, much to the chagrin of this particular academic who can't figure out why would nobody do this? I can't believe that they wouldn't give up the right to their money and hand it over to the insurance company and disinherit their kids or lose control of the ability to actually pull more money out than they want to, than the insurance company is going to send them. What if I have a big hit and I need a bunch more money and I want to go in and pull more money out? I can't figure out why they would not like the idea that they've got this annuity product that pays them the same income every year. And I use the example going back in the 1970s, a $7,000 income, $7,000 to $10,000 income is all you needed as a family to be just fine. Today, try to live on $7,000 to $10,000. It's not going to happen. With an annuity, what you're doing is you're getting that same payment every single year with a regular fixed annuity. You're getting that same payment unless you have a cost of living rider into it. And if you do, then the payment's way the heck less than what I just gave you right there. Payment's way lower than that because they've got to build in for themselves the ability to increase your payment in the future. They will start at a much lower level than $307 per month, as the example that I gave. Now, if you missed some of these numbers because you just tuned in, go back and listen to the podcast, paulwinkler.com. Check out the podcast on this because this is important stuff to get. Quite often what happens is we we'll read things like this, we'll hear things like this, and we don't know the numbers behind it. And I feel it is my duty to make you a more informed investor. And I take it seriously. All right, we're back here on the Investor Coaching Show. I say we because look who the cat drug in. Mr. Ira Work.
Well, I was in the neighborhood and thought, yeah, why not stop in for a little bit?
Yeah, man.
Not sure how long I'll stay.
Well, that's okay. You don't have to stay long. But I don't know if you heard what I was just talking about.
What was that?
A little bit. So I was talking a little bit about, there was an article in one of the financial planning publications, and you know how we're very much into academic research.
Absolutely.
Well, it was a person from a college talking about how Ken Fisher is all washed up regarding his "I hate annuities" stance. You'll see when you find ads all over the place. And he does a lot of TV advertising as well. But he has this big thing, "I hate annuities." And people accuse us of saying we hate them too. It's a tool. And sometimes tools make sense. Sometimes they don't make sense.
Right.
It's kind of our stance on it. But in this particular instance, he gave an illustration number. He says, if you have a 65-year-old woman, $50,000, and the insurance company is going to pay $5,000. If you're a fiduciary, you'd be hard pressed because the internal rate of return on a $5,000 payment is about 8%. Now, if those numbers were indeed correct, I would say, yeah, you would be hard pressed in some instances, to say that you'd be a fiduciary. Because let's say if all the person wanted was a guaranteed income and they weren't concerned about inflation at all, weren't concerned about giving up access to their money or the control or anything like that, there may be a case that does make sense. But what I did is I ran the numbers on immediateannuities.com. And there is a website you can actually run numbers to see how much income an insurance company, and they shop between several different companies to see who would pay the most amount of income. And the number came back completely different. $307 per month was the number, which is an internal rate of return that was much lower. It was more like 5%. Now, which is fairly high if you look at government bonds rate at 4%. And my point that I made was, how does an insurance company that has to make a profit pay you more unless they're taking more risks than just buying the bonds? And I pointed out that, yes, insurance companies do take more risks. And I talked about corporate bonds and the issues and reinvestment risk and things like that. So anyway, you're up to speed now.
All right. Well, the insurance company, let's break things down. Number one, the insurance company, some of the people are not going to live to take all their money out of the annuity. And when you do an immediate annuity, if let's say you put in $50,000 and you've only gotten $25,000 in income, the insurance company keeps you the $25,000.
Yeah.
So they know, based on the statistics of people living and dying, approximately how much of that they're going to keep. So as a result of that, they could tend to make the return a little bit higher than a government bond. Secondly, the insurance company.
No, wait. Now, hang on a second. So they when they're paying this money, if this person dies early, it's got to go to the person that lives longer. So therefore, what happens is they're not going to make a profit on just people that die earlier, unless they just make mortality assumptions that are shorter, or longer. Excuse me.
Well, it's all going to depend, because there are a lot of different ways to structure the annuity. So, for example, most of the people that I've done immediate annuities with are people who are not concerned about leaving money to beneficiaries.
Right.
There tend to be more single people, and they just want the maximum amount of money they can get for their lifestyle.
What age typically for you?
Because usually it's in their 70s or older.
Yeah, usually that was another point that I made, is that the only time that I have recommended it is people are much more advanced age, even in their 80s, up to the point where you got to watch this. Sometimes an insurance company won't issue a contract at all, depending on how old the person is. But that's a point that I made as well.
Right. So the other thing, too, to realize is insurance companies are not using insurance products to guarantee the income to the people who buy the insurance products.
Yes.
They're investing in stocks and fixed income government securities, mostly corporate bonds, because of the guarantees. No different than what we recommend based upon the academic principles that tend to lean toward, Nobel Prize winning academics.
Except that the insurance companies don't typically have much, if anything, in equities. So they're not using the multi-factor type stuff that we talk about here on this show, but they are using a lot of bonds. 62% was the number,
Right?
is how much they have in bonds. They have typically a lot of real estate is another thing you'll see in the portfolios. But to give you that rate of return, you would have to be taking, and the internal rate of return that he was talking about here in this article is over 8%. There ain't nothing out there that's paying 8% with any kind of safety. So if the internal rate of return is that high, there's no such thing as a free lunch, is the point that I was making. And, there, as this one article was pointing out, there's a lot of risk in the insurance companies, the annuities company, the balance sheets of these companies.
Well, that could be based upon and depending upon the insurance company. So an insurance company that has a lower rating, a more risky insurance company, will provide a return a little bit higher than you can get from a more highly rated insurance company, because that lower rated insurance company just wants to get more money.
Okay,
so therefore you're taking more risk.
Ready for this, Ira? You've been doing this how long now?
March will be 40 years.
Okay. Have you ever seen an insurance company that had an A+ rating or a very high rating when they issued products end up with a downgrade in their rating?
Well, I remember Executive Life, which
that was really baiting you. I know. I know you remember.
Yeah, I remember.
Know you do.
Executive Life, which was an A-rated company, actually filed bankruptcy.
Wasn't it A+?
Could have been A+.
Could have been. I don't remember. But yes, exactly.
But it was one of the better rated companies.
So the issue that you run into is that you could go out there and comb the ratings websites to make sure that you have a highly rated insurance company, only to have the insurance company invest in things later on after your contract is issued, the stink, and then all of a sudden the company gets taken down and the rating goes down, but you already own the product.
Yeah, the real reason why annuities are sold, in my opinion, is twofold. And one of them is the high commissions that they pay. And number two is agents can use the term guaranteed.
Exactly. So you have this in finance, Yahoo Finance, 8 reasons annuities might be a really bad investment for you. And you might want to just comment on a few of these as I go through it.
Sure.
I wasn't planning on doing this, but why not? A woman receiving terms of her annuity, pay $1 million up front, receive $5,000 a month after retiring. Simple, right? Unfortunately, annuities are rife with complexities and prevent a clear understanding of their benefits and potential pitfalls. Now, I'm just going to hit the negatives in here. The positives, reliable, long-lasting income. Now, the question is, will that income have the purchasing power? That's number one you got to think about. You got some tax advantages.
Okay, so...
And then there are tax disadvantages. You want to go through
all
those?
Right, so on the income that you can't outlive, that is all well and good, providing that we don't go into a period like we just have over the last year and a half to 2 years, where inflation numbers really increase the cost of your goods and services, the products that you're going to buy.
I mean, yeah, that is a huge issue.
So yes. So if you sign up and you get that immediate annuity and it's giving you $400 every month for the rest of your life, yes, if you live another 100 years, you're going to get $400 a month for the rest of your life, for the next 100 years. However, if the goods and services you're buying for that $400 goes up to $600, $700, $800, well, now you can only buy half of that amount of food, let's say.
Oh, there was a guy pitching a fit. It was a funny video on one of the streaming services. I don't even know what. but it was this guy's pitching a fit. This is how much I'm paying for gas. This is how much I'm paying for food.
I saw that.
Did you see that video?
I saw that. Yes, I did.
Yeah. What did you think?
I thought it was amazing.
He was having an absolute
meltdown.
It was.
He did it in his car.
Yes. You did see that video.
Yeah.
Okay. So you're that person that, let's say, you're getting that income and all of a sudden gas prices are going up. Your food bill is going up. Your gas, that you heat your house with, or electric that you heat your house with, is going up. Your phone bill is going up. A new technology comes out that you want, and now you can't afford it because you're on that fixed income, and the value of that paycheck is going down every single month due to inflation. What's your recourse? I mean, because what they'll do is in the sales process is, well, you don't do it with all your money. You only do it, you look at your fixed expenses and you set your income based on your fixed expenses. What's wrong with that, Ira?
Well, the problem with that is you might need all that assets that you have to help you manage, and you're not going to get any growth on any of those assets.
Okay, so I'm going to bait you on this one.
All right.
What fixed expense do you have that you have had throughout your, however many years that you've owned a home? Oh no, I don't want to be that specific.
I was actually
that wasn't even fair.
Well,
what fixed expense do you have that doesn't go up at all? Name all the fixed expenses that you have that don't go up at all. Over the past 20.
There's only one fixed expense that I have that has never increased, and that's my mortgage.
Thank you. Exactly. The insurance costs go up. The taxes go up.
Oh, my taxes.
Your expenses for your TV, your cable bill go up. Your insurance costs go up on your automobile, on your homeowner's insurance.
Everything.
What doesn't go up?
Nothing. Everything goes up.
You nailed it.
Except the mortgage.
The mortgage.
Right.
That was it. And do you still have a mortgage typically? Hopefully not, when you're in retirement. So the one thing that would have stayed a fixed expense is gone because you pay off the mortgage.
Unless you were silly and you bought one of those adjustable rate mortgages and you still have a mortgage and then interest rates go up, then your mortgage payment does go up in retirement.
Ouch. Yeah, just the thought of that. Is no fun.
No.
Yeah. So, I look at that and go, man, that whole premise is blown up. So let me hit the rest of it. Tax advantages. That's a double-edged sword because you have tax deferral on the interest, but.
Okay. So one of the questions that I get is, what can I do to reduce my taxes? And the only real answer to that question is make less money. That is it. So yes, you can put money into a product like an annuity or your IRA account, okay, diversified portfolio for your IRA, so you can reduce your current taxes on the income that you currently have, or you can reduce the taxes or completely eliminate taxes on the growth of your annuity or your IRA or your 401k until the time comes when you're taking the money out to live on. Because there are two phases. There's the accumulation.
And that's the problem. When we talk about tax advantages, they start to look really bad. Yeah,
right,
go ahead.
I'm just getting there. So there's two phases. There's the accumulation phase, and then there's the decumulation phase, when you're beginning to live off the money you've accumulated. Well, if taxes go up, as can possibly happen in 2025, because of the tax cut, and those are going to sunset in 2025. So we're going to see taxes go up. So now you're taking money out of those deferred annuities or your IRA or your 401k, and now you're paying higher taxes on that same money.
And it's last in, first out with the annuities.
Right.
So you put $100,000 in, it grows to $175,000, and then you start to pull money out. Let's say you don't annuitize because you're going, I don't want to lose control of my money. Now you got to burn through that $75,000 of gain before you get your principal back. Now that's really what we're dealing with here. So that's one thing. The other thing is they talk about fighting inflation. That's the problem with fighting inflation. You don't have that protection. Another one is annuities can be incomprehensible, was a point that they made.
All right, well, let's go back for a minute to the fighting
Okay.
inflation. I've had a few, 3, 4 clients call me and say, well, why should I stay in this portfolio when I can take my money, put it into a CD and get a guaranteed 5%?
Mm-hmm.
Well, there's 2 problems with that. Number one, that certificate of depression is what you're going to feel when you realize I'm only getting 5, but inflation's now 7, 8, 9%. And depending upon what you're really buying, some of the prices of food, inflation has gone up 25 and 30%. So you're getting 5, you're actually losing money to inflation.
And you can have issues with inflation even, I think about when you talk about food prices, why are they going up? Well, one of the reasons is you can have wars that actually cut off the distribution of certain food products from countries that produce a lot of that particular food product. Can we say Ukraine and grain?
Right.
So you look at that, and that has nothing to do with monetary policy as much as it has to do with geopolitical risk. So a lot of things that can come up that you don't even think about. So that's one thing right there. Product flexibility. They come in various types of these products can be fixed, variable, indexed, combination of the two. And then the thing that you can run into is you might have inflexibility. Which is liquidity issues.
Well,
if you need more money than what they're going to be paying you every month, let's say if you annuitized it.
But there's another problem. When you put that money into that, let's say 5% CD, and then the Fed begins to lower interest rates, banks begin to lower interest rates, the problem that you're going to have is what is known as reinvestment risk.
I mentioned that a little bit earlier before you got here.
All right, great. So when you have, let's call it that $500,000 that you just locked up in that, CD at 5%, and you're getting $25,000, and you need that to live on to pay all your fixed expenses, plus the ones that do go up, like your car, gas payments, insurance payments, and so forth. But now the interest rate didn't go down that much. Let's say it only went down 1%. So now it's 4%. Instead of getting $25,000, you're getting $20,000. In the meanwhile, a lot of the people that have cash sitting on the side, they're now realizing I can't get much money in the fixed income investments. They push that money back into the stock market, driving the stock market further up.
You're so right. Yes, I was going to go there if you didn't.
And then you begin to draw money off of an asset that actually increased in value.
Or before you were in it.
And you miss out on that gain as well.
That is absolutely brilliant and exactly right. Because what happens quite often when interest rates go down, we see stock prices jump in anticipation that interest rates are going to go down. We saw that in the last quarter of last year. The thinking was that interest rates were going to go down, and then you had this huge appreciation in stocks in anticipation that that was going to happen. You don't even have to wait for it to happen, and it happens.
Well, the problem is that everything we're doing is waiting, right? We're waiting for interest rates to go down. We're waiting for the stock market to go up. Because the reason we're waiting is we have no control. The only control that we really have is to diversify the portfolio and rebalance. And that helps manage the risk of the portfolio. It helps get higher rates of return. But inflation is an animal that I've watched for 40 years now. And there's just no way around it. You just need to invest in a way that will keep up and hopefully outproduce inflation.
So we just happen to hit this thing. The annuities might be 8 reasons they might be a really bad investment for you. Another one that they gave in here as a reason that might be a really bad investment for you is burdensome fees. And the insurance company is going to have to make money, but not only the insurance company having to make money. Who else?
The agent.
That's right. You got to pay the commissions. You got to pay, maybe renewals or whatever.
And that's why there's a surrender charge. I mean, look, when we talk about we hate annuities, we don't really hate annuities.
That's you can't say that. That's Ken Fisher's line.
All right.
We don't hate them.
Here's the thing. We actually have annuities available. And there's really only one time when we use
annuities.
Well, that's the type of annuity that we have. that we work with.
No commission.
No load.
That means.
More importantly, no surrender charges. You want to get your money out of it a week later, well, let's say 45, 50, 60 days later, because most annuities have either a 15 or a 30-day free look where you get your contract and you get to read the contract if you can understand the contract and you come to the conclusion that this is
You're
not
a rocket scientist.
this is not something that you really want to stay in. The company will send your money wherever you want them to send it. So if you decide 60 days, 80 days, 100 days later, after the annuities that we do work with that doesn't work for you, there is no surrender charge. Most contracts that I've looked at, you're going to lose 12.5% if you get your money out in the first year. So when they say your principal is guaranteed, yeah, it's guaranteed as long as you keep it in there for 12 years or 7 years, whatever it might be.
Right.
But so the time that we do recommend the annuity is simply this. If you've invested, let's say, $50,000 in a non-qualified or a non-IRA type of annuity, not a retirement, a lot of advisors out there are recommending you roll your 401k over into an annuity, and it's under an IRA program. So if you went to an advisor and said, well, I really don't want to pay taxes, what can we do? And you take $100,000 and you throw it into a non-retirement type of annuity to protect it because they sold you on fear. You can't lose your money. They sold you on greed. You can get the returns of the market.
As long as based on the insurance company strength.
Okay.
Yes, you got to throw that in there.
So is when you've invested in a non-retirement annuity, it grows from 50 to 100. We'll use an annuity so you don't have to pay the taxes pulling that money out, but you get the diversified portfolio.
Yeah, and then we call it 1035 exchange. So yes, there have been instances. So anybody says that Winkler and those guys don't ever do it, and that's not true. There are times when they do make sense.